was teaching high school, we had Spirit Week, and one of the days you're supposed to dress like what you want to be when you grow up, so I dressed as retired. Because that's what I want to be when I grow up. Retirement is the point in your life when you stop working full time. Or stop working your main job. Semi-retired is when you continue to work after you've retired, either at the same job part-time or you go get a different job, and so you've retired from your main job and then you go get a different job, and you can do that for 2 reasons. People do that for 2 reasons. 1, they're bored. 2, they need the money. Those are the 2 main reasons. Pre-tax dollars is money taken out of your paycheck to be put into a retirement account, and this happens before the taxes are collected, so you do not pay tax on that money at that time. You pay taxes on this later. And then after-tax investments is money invested after the taxes have already been taken out. So either going into some other kind of an account or a non-tax deferred retirement plan of some sort. 2 different kinds of IRA or IRA accounts. You have a traditional and a Roth. There's not a huge amount of difference between the individual ways in which they work and the interest rates. But with a traditional IRA, you don't pay taxes on your deposits. So you can either have the money comes out of your paycheck before they calculate taxes, or you take the money yourself and put it into the tax account, the retirement account, and you list it on your tax return, and it lowers your taxable income because you don't pay taxes on this money yet. When you turn 59 and a half years old and you can withdraw the money, you then pay taxes, income tax, on all of the money that you withdraw. So during the course of a year, it's considered your income, all of your withdrawals, and you pay income taxes on this. So you don't pay taxes on it initially, but you do pay taxes on it when you retire. The Roth IRA is different in that you pay taxes on it initially. So you can't do a pre-tax deduction from your paycheck. This comes out, you pay taxes on this money. However, if the money has been in the account for at least 5 years, when you withdraw it, you pay no taxes on the withdrawals and no taxes on the interest. So in that way, that's kind of nice, because the money that's withdrawn from the account, you won't pay income taxes at that point. So if you have a Roth, let's say this is your only type of retirement account you have, either traditional IRA or Roth. If you do the Roth, once you retire, you're not paying income tax anymore. You've paid taxes on all that money when you initially deposited it. So then you don't have to pay income tax anymore. Whereas with the traditional, you don't pay income tax when you put it in there, and so it gives you kind of a tax break now. And some people, what they do is they take the tax break and the tax returns, and then they invest it back into the retirement account. The 401k is an employer-sponsored plan, and what happens is the 401k is like a group retirement plan. Everybody's money gets invested together. All the employees. Now, of course, they keep track of how much is whose, and individually they keep track of whose money is what, but it all gets invested together, and that way you're able to buy more shares of stock and do things like that because you've got like this pool of money. And so usually the 401ks tend to be stock or bond based. There are some 401ks that are annuities or mutual funds, but these are not like just a savings account where the money just sits there. It gets invested. The nice thing about that is if whoever's managing it is managing it well, you'll make good money. The bad thing about that is if there's another stock market crash, there goes your retirement account. Okay. And a lot of times the 401k plans, because they're employer sponsored, if you work for a publicly traded company, a lot of times your 401k retirement is in company stock. Like they'll have stock options where they match stocks. So for every dollar you put in, they match $1 worth of their stock as well, kind of thing. Which is, again, is really nice because it will build quickly unless, of course, something happens and the company's stock tanks, in which case it's not good. A Keogh plan is similar to a 401k plan, but it's for self-employed people. So what they do is they take a bunch of people that are self-employed or small business owners that want to invest in a retirement plan, and you go to, say, one of the stockbrokers like Merrill Lynch or Charles Schwab, or I can't even remember all the names of them, but there's a bunch of them. You go to one of those and you join into a Keogh plan, and it works very similarly to a 401k plan, but it's not employer sponsored, it's for self-employed people. And then you have a 403b, which is a tax deferred account, but you have to qualify to be able to have one of these. Public school employees, nonprofit organizations meeting certain requirements, like have certain statuses, and then also clergy members can actually get the 403bs, and they're usually an annuity plan or mutual fund plan. But again, you have to qualify to be able to get one of those. So, all right, so here we go. Do you remember this formula? This is the deposits. This is the periodic deposit formula, and it's going to tell us our balance in the account. So Blythe is 40, and she's going to retire in 25 years. And she's opened an IRA with a 3.8% APR, compounding monthly, and she's going to make $500 a month deposits. We want to know how much is she going to have in 25 years in the account. So just as a refresher, this is the deposit amount, R is the rate, N is the number of times compounded, and then T right there is the number of years. Okay, so she's going to deposit $500 a month at 3.8% compounding monthly for 25 years. Okay, 0.038 divided by 12 is 0.00316 repeating. And 12 times 25 is 300. So what we have is 1.00316 repeating, raised to the power of 300 minus 1. So I'm going to have 500 times 3.58183143. So 1790. So when she retires, she will have $565,552.33. She will be 65. Now, her annual contribution was pre-tax. So if she puts in $500 a month for the whole year, she's put away $6,000 that year, right? So her income was $72,500. If you take out the $6,000 that she now gets to take out of that for non-taxing purposes, that makes her taxable income $66,500. So I put the wrong boxes in here. Oh no, her taxable income, I read it wrong. Never mind. I didn't put the wrong boxes in. Her taxable income was $72,000, so we have to add the $6,000 to that to get her actual income of $78,500. So this was taxable. This was actual. Okay, so her tax was $72,500. So she was right here. And before that, she was at $78,000. Okay, so I did put in the wrong square. Okay, 78,500 was 15,975. I put in the 75,000 instead of the 78,000. So, oops. Anyway, and this tax was 14,161. So she paid 14,161 when she could have had to pay 15,975. So she saved 1,814 in taxes. Does that make sense? If I had put the right thing in there, it would have made even more sense. The periodic deposit formula reworked so that you can find out the amount of the deposit to reach a goal. Okay. So Chelsea's 45 and she wants to retire when she's 62. So first we figure out how many years is that. So she wants to retire in 17 years. Okay. She wants to have $300,000. And we want to find out how much does she need to put away monthly to reach that goal into this account with 2.25% interest. Okay, so her goal is 300,000. The interest is 0.0225 monthly, so 12 again. And then 1 plus 0.0225 divided by 12. 17 years minus 1. Okay, so 0.0225 divided by 12. And 12 times 17 is 204. So it gives me 300,000 times 0.001875. And 1.001875 to the power of 204 minus 1. Okay, she's going to have to put away $1,208.59 every month to reach that goal. But if you think about it, she gave herself a short window of time. She only gave herself 17 years to hit $300,000. So, you know, again, if she started when she was like 20 or 25, she could have put away half that amount of money. So Xander is a 50-year-old married man who files taxes separately from his wife, so he's filing separately. And he had been making monthly contributions to his IRA for many years. And he wants to withdraw $50,000 to make the initial investment in the partnership. Okay, his taxable income was $96,000, but because he withdrew this $50,000, this gets added to his income. And he pays a 10% penalty.
That's ridiculous.
No, your retirement account, you're not allowed to withdraw the money until you're 59 and a half.
Oh.
That's like the law. So if you withdraw it early, you pay a penalty of 10% of the money you withdrew. So taxes. Okay, his original taxes were on the $96,000. Okay, which is right down here somewhere, 96,000, and he's married filing separately, so it's 20,777 in taxes. Now his new income adds the 50,000, which makes it what, 146? Yeah, 146,000. So we would go down here between 108,000 but not over 194. It says 146 times 33%. That would give me 48180 minus 11,546.75, which would make his new taxes 36,633.25. Okay, so his extra, how much extra did he pay? So we have extra taxes. So I take that 36,633.25 and I subtract the 20,777. So he paid extra tax of 15,856.25. Plus he has a 10% penalty of 50,000 on the 50,000. So I do 0.1 times 50,000, which is $5,000. So his total extra that it cost him is 20,856.25 because he took out that money early. Sometimes people don't consider that. They think, oh my gosh, I need this money right now. They don't think about the fact that the 50,000 he took out, it cost him almost half that in extra taxes and penalties. You know, that's right there, $20,856 you're just throwing away. So, you know, before you touch your retirement account, always try to find any other possible options so that you don't have to pay that extra tax and extra penalty money. Employer matching plans, this is what I was talking about when you have a 401k plan. Your employer matches a certain amount, and it's usually a percent. And there's usually a maximum. And it's either a maximum percent or a maximum dollar amount. They might say something like, well, okay, in this example problem, they'll match 50% of your contributions up to 6% of your salary. So if you put in $200 a month, they'll also add $100 a month, but only until they hit 6% of your salary, in which case they'll stop adding the extra money. So Leo makes $75,000 per year. They'll match 50% of his contributions up to 6% of his salary. So they also maximize for 15% of his salary, and the maximum contribution is $16,500. Okay, he wants to maximize his employer's matching contribution. So first let's find out what all these percentages are. Okay, so 15% of his salary is 15% of the $75,000. So that is $11,250. This is Leo's max. So he can't even hit this 16,500. So that we can ignore that. His max is 11,250. Now, 6% of his salary is 4,500. This is the contribution max. Okay, that's the most that the employer will contribute. Okay, they will match 50% of his contributions. So if he puts in the entire 11,250, it would be 5,625. So they're gonna only go to this amount. This is his contributions. So if he wants to maximize his employer's contribution, bless you, he needs to find out what twice this is. Okay. So 2 times of the employer max is $9,000. Okay, he's not trying to maximize his contributions. Right here, he's maximizing his employer's matching contribution. So he wants to put in $9,000 a year. Okay, so we'll divide that by 12. And he needs to put in $750 per month to maximize what they will contribute. Okay, does that make sense? If we were talking about maximizing what he contributes, we would have divided this 11,250 by 12. But we wanted to maximize theirs, and they're going to stop when he puts in 9,000. So he's just going to hit their max rather than his own max. Does that make sense? Social Security benefits were established by the Social Security Act in 1935. Thank you, President Roosevelt. It was created it created an insurance program that paid benefits after you retire, and this was a direct result of the crash of 1929 and the subsequent depression. It can be used for retirement. You have to be 67 or older to receive full benefits. You can retire earlier than that, but you don't get your full benefit. Survivors, so for example, if someone passes away and they have children under 18 or a spouse, then they have survivor benefits under specific circumstances, or disability insurance, which is OASDI, and that's for people that go on permanent disability. Your benefits are based on your lifetime earnings. Full benefits if you're 67. You can retire as early as 62. That's the earliest. But you do get reduced benefits. Now, that doesn't mean you can't retire earlier than that, I guess I should say. You can retire earlier than 62, but you cannot claim benefits until you're 62. So you can quit working at 50 if you have the money to do so. But you can't claim Social Security until you're 62 at the earliest, 67 to get full benefits. Of course, if you have the money to retire when you're 50, you probably don't care all that much about Social Security anyway. Okay. In 2009, there's a maximum salary that gets charged Social Security, and it is $102,000. Okay, So in 2009, Jose had 2 jobs. Oh, I forgot to tell you what OSDI stands for. Sorry. It's Old Age Survivors and Disability Insurance. See, Old Age, OASDI. That's what that stands for. All right, so Social Security maximum is $102,000, and it is 6.2% of your income. Okay, so if you work 2 jobs, doesn't matter how many jobs you work, you only owe up to $102,000. Anything that you earn above that should not be taxed for Social Security. So if you overpay, you get money back. Okay, so Jose worked his 2 jobs. And his 2 bosses are not responsible to figure out who charges what, right? They just charge theirs for their, because he's under 102,000 on each of them, and then it's the government that has to give him the money back later. So he actually made $115,006, and he should have only paid 6.2% of that 102,000. Okay, so what he should have paid was $6,324. What he actually paid was $7,130.37. So this is he should, and this is how much he did. So to find out how much he overpaid, we take what he actually paid, we subtract what he should have paid, and he is owed $806.37. Security statement. Your Social Security statement is a record of your money earned, and that's each year. And then also the money paid into Social Security. And you can request or you get one annually. I don't believe they automatically mail them out annually, but you can request one annually. I think they mail them out every few years. Okay, you earn Social Security credits. And you have to have earned enough credits to receive the benefits. You have to have earned 40 to receive benefits. Okay, the way you earn credits right now in 2015, every $1,220 earned equals 1 credit. And there is a maximum of 4 credits per year. Okay, so the first $4,880 you make in a year earns you your 4 credits. You have to work for 10 years receiving 4 credits a year in order to qualify for Social Security benefits, to have enough credits to receive them. And the reason they made it, you might think, well, that's really small, but the reason they made it so small is so that people that did not earn a lot of money could still get their credits, to get those 40 credits, in a decent amount of time. So, Fran requested her annual Social Security statement, and she wants to check how many credits she received. She worked all year, and she earned $8,102 per month. How many credits did she earn that year? This is a trick question. How many are you allowed to earn in a year? 4. And that's for each $1,220, which if she earned $8,000 a month, she earned that in her first month. So she earned 4 credits. Yeah, you have to earn 1220 to earn 1 credit, but you have a 4 per year max. So some people, if you make more than 48 or 50,000 a year, if you make 48 or 50,000 a year, you earn all your credits in the first month. So if you make more than that, you earn all your credits in the first month. If you make $200 or $300 a month, it'll take you 6, 7, 8 months to earn the credits. Does that make sense? So, but it's a 4 per year max, period. And then you have to have 40 credits to receive benefits. So you have to max out for 10 years in a row. Like that would be the minimum to earn benefits. Yeah, you can go online and check, and you can receive your statement. You can request it annually. So it's based on credits, and it's based on the amount of money you put in. So your benefit, you have to have 40 credits to earn benefits, but your benefit is based on how much money you put in every year. So if you only earn $5,000 a year for your whole life, your benefit is going to be really small. So like this person, Fran, she earned $8,102 per month. She's going to max out. So hold on. Yeah, she's earning $97,224 per year. And so she's paying in $6,027.88 paid in.
So how do people get SSI when they haven't even earned all their credits? Or not even, like, none?
A little while. Okay, so Beth earned $3,600 for the first half of the year, but then she didn't work the rest of the year, so we want to figure out how many credits she earned. It's $1,220 for 1 credit. So we're going to take that 3,600 and we're going to divide it by 1220. I'm going to rewrite that, sorry. Now, you do not earn partial credits. So it actually ends up being 2.9508, etc. She earned 2 credits. Okay. If she had worked and made like even probably $60 more. Yeah, if she had earned $60 more that year, she would have earned 3 credits. But because she didn't, she only earned the 2. Okay, your Social Security benefit, not benefer, is based on your highest 35 years of earnings. So they take your 35 years and then they average it, and then you get adjusted for inflation. Okay, so she earned, let me just double check something. I don't have the current, but in 2007, okay, this is only in 2007, you get 90% of the first $680 per month. And then you get 32% of the money between $680 to $4,100 per month. And then you get 15% of over $4,100. That was the formula that they used in 2007 to calculate your Social Security benefit. So she earned $2,300 per month. So we take out $680 of it. Which gives me $1,620. $1,620, or the $2,300 is right between here and here. So she's going to get 90% of the 680 and 32% of the 1620. So I take 680 times 0.9, and that's 612. And I take 1620 times 0.32, and that's 518.40. And I add those together, and her benefit is 1130.40 per month. Remember I said you had to retire at 67 to receive full benefits. Okay. Full benefits are in 2007 because we're using those numbers because that's what's in the book, and I could not find the current year, and it won't matter because it's going to be different by the time you guys retire anyway. You get 90% of the first 680, 32% of any money between 680 and 4100, and then 15% of anything over 4100 of your average salary. They take the average of the 35 years, your highest paid 35 years, they average that, divide it by 12, and then they calculate. Then if you retire early, they reduce it by a percentage. So if you retire at 62, you take that calculation from up top, multiply it by 30% and subtract that. Or I guess you could multiply it by 70% and keep it. Okay, so it gets reduced by 30% if you retire at 62, by 25% if you retire at 63, 20% at 64, 13.3% at 65, and 6.7% at 67. So that's how much you lose per month if you retire early. Retired at 65. That's a 13.3% reduction. Okay. So we have a 13.3% reduction. Her benefit would have been 1130.40. Okay, so two ways to do this. I'm going to do a method 1, method 2. Pick the one you like best. Method 1, I take that 1130.40 and I multiply it by the 13.3% reduction. And that gives me 150.34. And then I take her 1130.40 and I subtract the amount that she's losing. And she's actually going to get 980.06 per month. Okay, so that's method 1. Method 2 is I take 100% and I subtract 13.3%, because 100% is the full benefit and 13.3 is the amount she's losing, so she'll actually get 86.7%. And then I take her 1130.40 and I multiply it by 86.7%. And I get the same amount, 980.06. So either method works. Pick the one you like best. I can follow both of them. And then for the second part of this, what if she retired at 62 versus 67? We're going to find the difference in the benefit. Well, at 62, she's losing 30%. So I'm just going to use the 100% minus 30% thing. So she'll get 70% of her benefit. Actually, I'm not going to do that. That's silly. If I'm finding the difference is the 30%. So multiply that by 0.30. She would actually get $339.12 less per month. Okay. See ya.